Not one economist on the mainstream media or government's payroll can name the economic mechanisms that would be responsible for a recovery in unemployment numbers or housing. All they can do is point to fake numbers and the promise of the US government, which doesn't mean a whole lot to me anymore. And Ben Bernanke came out today, or yesterday, with a statement about the recession and said, quote, "From a technical perspective, the recession is very likely over at this point. It's still going to feel like a very weak economy for some time because many people will still find that their job security and their employment status is not what they wish it was. So we're going to experience a very weak economy for some time, even though you call this a recovery, Ben Bernanke. The fact is, since the crisis began, neither the Fed or the Treasury have done anything to address these toxic assets. Commercial and residential real estate continue to drop, which will just produce more junk mortgages, while banks are already being choked by worthless securities from when the crisis originally began. By December of last year, U3 unemployment was already at 7.2%, and U6, which uses much more realistic calculations, was at 13.5%. That was nearly a year ago, and U6 almost doubled U3 figures. In fact, if we had followed the same model for calculating the unemployment rate as we did during the Great Depression, the unemployment figure for December of 2008 actually would have been at 17.5%. And in July of this year, according to John Williams at shadowstats.com, who I have a subscription to, unemployment rose to 20.6%. So we can clearly see that if you follow the trends, this is not a recovery. Keep in mind that about 3 years into the Great Depression, unemployment hit 25%. So to say that we can't see unemployment at 25% within 2 years wouldn't be realistic. The only difference is the government and the media will be saying for years to come that we aren't in a depression when we are, just like they did when they denied the recession. But unfortunately, we are going to see more unemployment. We're going to see unemployment numbers continue to rise. And Ben Bernanke is completely wrong. This is not a recovery that we are seeing. We cannot have an economic recovery happening right now when we are witnessing depression-level unemployment. It just can't happen. Anyone who understands anything about basic economics knows that you always look at a variety of trends when making forecasts, something the government often fails to do. But they just don't overlook the important facts, they hide them, and they lie out of their back teeth by manipulating economic data. Last summer, before the collapse of Lehman, the Fed was talking about economic recovery, and that's the exact same thing they're doing right now. Another major problem when talking about the so-called economic recovery is real estate. Just because a peak in subprime mortgages has already occurred doesn't mean the worst is over. In fact, the worst still has yet to come. Some of you might remember me talking very briefly about the next wave in mortgage defaults that is headed our way in a previous video I did earlier this year. Well, unfortunately, this still holds true. For example, the pay option arm in all A mortgage problem that we currently have probably won't peak until fall of 2010. And those who say that all A mortgage products aren't harmful because of low interest rates are dead wrong. Not because number one, the problem actually lies in the large number of recasts, not resets, that will be occurring over the next few years because of the negative amortization option that borrowers went with. And two, although interest rates are low right now, and that is helping out in this environment, there's the simple fact that interest rates won't remain low forever. In fact, out of the $189 billion in option arm loans outstanding, 70% will recast within the next couple of years. This means that when the problem hits in full force in 2010, around $8 to $10 billion per month will probably recast, compared to what I believe are a few billion dollars of these loans which are currently recasting right now every month. Also, according to Fitch Ratings, only 3.5% of the 1 million option arm loans have been modified, although loan modifications won't really help because the banks still keep these assets on the books for full face value. And it's amazing how quickly these loans are going bad too. In fact, 46% of option arm loans are 30 days late. States like California, Nevada, Arizona, and Florida will probably be hit the hardest too because most of these loans were made in these states. Analysts also estimate that losses could range anywhere from 35% to 45% as long as home prices don't decline in areas where the loans were made. A lot of these mortgages were also attached to homes with at least 2 mortgages, which is another major issue that the media isn't talking about. But maybe I'll get into that in another video because I'm on a limited amount of time. So here we have rising unemployment and plunging housing prices, prime loans, the pay and option arm, and all a mortgage disaster, in conjunction with the new wave of subprime loans that were written by Ginnie Mae, FHA, and Fannie Mae and Freddie Mac, and they are already calling this an economic recovery. Until unemployment and housing recovers, the U.S. economy itself cannot recover. But keep in mind that while this housing crisis and rising unemployment is making this depression much worse, it is not the cause of this economic crisis. They are more like byproducts of a very bad economic policy that the government has been pursuing for many years. And there's also the simple fact that the higher unemployment rates go, the more foreclosures we will see. In fact, the Washington Post even said in one article that I just found, quote, "The country's growing unemployment is overtaking subprime mortgages as the main driver of foreclosures." So this itself is a game of dominoes, where each problem has a spillover effect. And let me repeat myself. What I just went over had to do with real estate, residential real estate. We still have the commercial real estate crisis that is heading our way. In fact, commercial real estate is crashing faster than residential real estate. Now keep in mind that the biggest banks were mainly affected by the subprime mortgage crisis. With the commercial real estate crisis, a larger number of small and medium-sized banks will be affected because they hold greater numbers of commercial real estate loans. This alone will hurt small business employment because smaller institutions provide credit to small businesses. In fact, credit is the lifeline of many small businesses. The FDIC even said that they expect 500 banks to fail in the coming months, largely because of the commercial real estate crisis. According to the MIT Center for Real Estate, commercial real estate, which is valued at $3.5 trillion, has experienced a 39% price decline in prices from the peak only 2 years ago, which is even greater than the 27% commercial real estate decline that we saw with the savings and loan crisis. So this is going to be a very violent blow to the banking system once again, especially since nearly half of all commercial real estate mortgage loans in the U.S. will be coming due within the next 5 years. Deutsche Bank even said that they believe that 65% of more of these loans won't be able to qualify for refinancing too. This will no doubt be one of the larger bombs that will drop in this credit crisis, along with the next wave of residential mortgage defaults, turning it into a severe depression. Based on what the government has already done, I don't think they'll be able to do much to soften the blow. Of course, things can be done right now, like making changes in real estate and mortgage investment conduits and bank regulations, which I don't have time to go into right now. But at this point, I don't think it's going to make much of a difference. It's going to hit us pretty hard. I will be posting part 2 to this video, in which I will be talking more about the toxic asset bloodbath the Fed and Treasury have failed to address, and some other things that are very important. So I will see you in part 2 of this video.